Welcome. This is Tommy Ruke presenting the part 2 of the inland marine coverage considerations. If you have any questions during the presentations, type them in the chat window. They will be answered at the time allows, or we'll respond later after the webinar email, and if it's appropriate, we'll share the answers with everybody, meaning it's not on a particular risk than a general questions. Also, if you have problems listening to the program from an audio standpoint or seeing it, please type in the chat window if your computer program still has their presentation, or call our office at 800-741-4084. We'll attempt to correct the problem as soon as possible and get going. We did part 1 last month, and in part 1, they review the coverages provided. We started realizing that a motor carrier has property, and that property in most cases is at a location. The smaller ones might not have much of a property. They might be at their office in a home, or rent a storage facilities. But in general, they do have a location that they'll have property at. That location would be covered in a lot of cases, or most cases, by a commercial package policy, which is part of the ISO program. That policy is location dependent. When you give that underwriter, or if you're the underwriter, you get the address of the property, you look it up at Google Earth, or you send an inspector by, you expect to find the property at that location. The items that we'll find there will be the building, the business personal property owned by the insured, or property of others, depending on how extensive the program is and if they own the buildings or not. When we look at that coverage and we start talking about motor carriers, particularly larger ones, we need to understand the definitions of these items in the form itself. The example that we used in last presentation was the building. An example that I like to use explaining this is a lot of our motor carriers have garages. If we walk in the garage, we'll see that that garage will have a hoist. That garage, in a lot of cases, will have an air supply from a compressor and outlets at the work base of the mechanics to inflate tires, or to give power to certain tools to operate. All that stuff is permanently attached to the building, and under the definition, those items are building, not business personal property. The concern you have if you don't properly allocate it into the limits, you have a co-insurance problem, because each limit requires it to meet the co-insurance requirements. And or if you have dollars there, you can't take the dollars out of the business personal property coverage and allow it to the building. So you need to look at those definitions. You have insurance will have a lot of things. Truckers that will have counters built in for the driver to work off of or work over. You'll have park bins and things like that. You need to understand those different definitions, particularly the ones that deal with buildings, and understand that you have to have separate limit of each. Business personal property, the coverage is in 100 feet of the premises. Sometimes we don't understand this. Notice if you looked at the form, it did not say 100 feet of the building, it says 100 feet of the premise. That is, in my estimation, or my thought, is 100 feet outside the lot line. Some enhancements of carriers that you might have will have been extended beyond that. What you have within 100 feet are items in the building itself. Their business personal property, their computers, their copiers, the desk, the equipment, those kind of things. Plus, you'll have the property in the units within the 100 feet of premises outside the building itself. So you can have a forklift, you can have computers inside the buildings, you can have property of others in that building. How it works is, because now we have a conflict in this, and this gets back to the first discussion of inland marine. We can write things like the computer. A lot of computers, and most computers, are written on something called electronic data policy, EDP policy. We write the forklifts on the marine contracts equipment policy. Or we have a situation where the units are loaded and parked outside the building. One of my favorite insureds in the time ago, one of my first commercial insurers, and some of you who have been to my presentations know that I use that insured as an example, and we'll do later in this cargo session, but they are a beer company. The way they operated is that the drivers came in and turned in the inventory that they had taken out the day before. They account for that inventory by receipts, and they deposit the money or give the money to the proper authorities and therefore finish the day's activities. Then they give the warehouse people a load sheet anticipation on what needs to be loaded on those vehicles for delivery the next day. The warehouse person then loads those vehicles and parks them outside the building within the fence, 100 feet of the premises. As a bookkeeping situation, the warehouse people actually takes the property out of, quote, inventory on the computer and assigns to each driver. This particular risk was written on a reporting form, and that requirement was that they had reported 100% of the value of the covered items under the form at the end of each month. Well, of course, the way most of your insureds would do that is that they would run the inventory on their computer and would use that as a report. The problem is the inventory on the computer doesn't account for that property in those vehicles outside the building, inside the fences, yet the definition of the property coverage itself says that that is still covered property. So we have situations where there's items that meet the definition of covered property on the form, but the CPP policy addresses it, but we also could cover that with the inland marine form. We could cover the computer with EDP policy. We could cover the equipment that we have, forklifts and front-end loaders or other items like that with the inland marine policy. We could cover the property in the units in a cargo form. How the two policies then work together is the CPP policy does not respond if the coverage items are covered by a form more specifically described. Again, EDP, contracts, equipment, cargo. What happens in those cases is that then the inland marine policy pays first, and the CPP policy would then pay in excess of the inland marine policy. So, for example, in cargo, again, a lot of times we have a catastrophic limit where you have a limitation where we'll have a limit per vehicle but no more than 2 vehicles. You would collect the 2 vehicle damage on the cargo form and then collect the excess on the inland marine form. So you need to look at those things and work together. But let's look at the inland marine form in general. When you hear the term marine, what comes in your mind? Well, marine. The form. Is it wet? We think of oceans when we do that, water when we do that. What type of property do you think of when you consider the coverage provided by the marine? And here's the situation, the specialty property, or property that has no location. The main exposure for inland marine addresses is property that is not at its fixed location. So why the insured needs inland marine coverage is when obviously any insured needs coverage. Their property that they have, they own, or responsible for is not covered somewhere else. So inland marine coverage form is not location dependent. It covers a property wherever the property is found. So the coverage is away from the location where the CPP policy is location dependent. It covers own property and equipment. It also covers the motor carrier's bailee responsibility or the transportation company's bailee responsibility. This, again, is an inland marine product covering the responsibility of a person who has property of others, and they have to take care of that property of others, and they have to return that property in the condition they got it, save what they were supposed to do to it. We deal with a lot of bailees. Some of you might not have been familiar with that term, but a laundry is a bailee. Any kind of warehousing facility is a bailee. A transportation company clearly is a bailee. Anybody with property of others. One that we deal with often is garages, and we have a garage keepers policy that buys back that bailee. So why do insured needs an inland marine policy? First, they have coverage nowhere else. The reason they don't have coverage is because the property does not address the exposure. The property coverage does not address the exposure that you have. So we look for the form that then tries to cover. Key point. I'm going to emphasize it here. I'm going to emphasize it even more in section 4 or hour 4 of this. There's no standard forms. You must read and understand coverage in each insured's forms. They can all be different. In my opinion, overview, there are more different forms writing inland marine, particularly cargo, than any other lines of insurance. You have people who have a inland marine department in the standard companies. You have specialty inland marine carriers, and then you have the specialty types of risk carriers, contractor specialty insurance companies, or trucking motor carrier special insurance companies, and they have their own form. You not need to read and understand each one of these forms. I learned this early in my insurance career. Going back to my favorite insured, the beer company. They were my first commercial insured. Greg, who owned it, knew me well. I had sold them trucks as an International Harvester dealership before I got in legitimate business selling insurance. Greg let me quote his insurance once I got in the insurance business, and I was successful with a price to deliver a policy to him. Shortly after I delivered the policy, within a couple of weeks, Greg called me up and said, famous words none of us ever want to hear as an insurance professional. Tommy, did you read the policy that you delivered to me? What do you say to Greg? Let's go down and have a beer? I said, he already knows this is the first commercial policy or one of the first commercial policies I've written. He said, dear friend. I said, what's wrong, Greg? He says, Tommy, you issued me or covered me on a cargo form that excludes alcoholic beverages. This is a beer company. He said, Tommy, what do you think beer is? He used adjectives I can't use here. I learned on my first commercial account to read the policies, particularly in marine, they all can be different. We were more than happy to rectify that problem, but I delivered as one of my first commercial risks, or policies, a cargo policy covered a beer company that did not cover alcoholic beverages. So marine forms are unique for also another reason. They're not controlled by the insurance regulatory. Foul lines of insurance. Some of you who are in this marketplace deal with wholesalers who also deal with excess or surplus lines. Same kind of concept. It is a admitted insurance company. For auto liability, for general liability, and property are admitted lines of insurance. Those forms must be filed with the individual state's insurance departments. A lot of the carriers use ISO or other agencies to file the forms on their behalf and then modify them or either accept the ISO forms and or modify them. They file the rates, they file the rules, they file what's being charged with insert parameters for credits or not. And actually the insurance department comes and audits them to make sure that they have conformed with that filing and that they are delivering the policies at the price they have told the state they would, and that's protection of the state. So all these forms, the auto liability, general liability, and property, the insurance companies and the underwriters are limited to what they told the state they're going to do. In marine traditionally is unfiled. Some states will copy the forms, but it is not heavily regulated as to forms and rates, similar to surplus lines carriers. So in inland marine, you don't have the same limitations that you have writing auto liability, general liability, property, where you're limited to a number of endorsements and you're limited to a pricing protection. So the coverage can be modified and meet whatever the insured needs are. Here's a key consideration. This is one of the things why I like inland marine personally, is that when you analyze the insured and you come up with their exposures, then you look at the inland marine form itself and determine if the coverage is there. And if it's not there, then you talk to the underwriter to talk about can we cover it or not. So we have to look at the pricing and the coverage. And we can do anything the underwriter is comfortable with, both price and exposure. Again, one of my favorite clients, the beer company. One of the policies I wrote with him is an inland marine product called a MOP policy, manufacturer output policy. They're subject to distributors. The advantage of that property form is it covers the building, the personal property, and the cargo exposure under one form. The underwriter I was dealing with was up against a credit. He wanted to write it. We maximized credit. We were trying to get to the place we need. And I called Tom up and I said, Tom, I need a little more credit. And Tom says, look, I got people who watch me. I got a document if I give it any more. I can't think of any more credits I can give it. I maxed that out. I said, Tom, do you realize that beer put fires out even before you recycle it? He says, Tommy, that's a good idea. And I got another 5 points, and we worked the risk. That kind of discussion obviously can be done. More appropriately is you can discuss any exposure, and the underwriter, if they're comfortable with it and can justify it, have, in most cases in the marine, the flexibility to meet the insurer's needs at the price they think is appropriate. So the key part here is the premium for protection. And as an insurance provider or an underwriter or a retail agent, that is the balancing act by divulging all the exposures that the risk has and then negotiating the premium that is needed to write the policy. Again, most often these premiums and these rates are not subject to any rate filing that we can look at through the Department of Insurance, but individual insurance carriers' filings that they have. So one of the main exposures addressed by the Marine is the question is providing them more coverage. So what property exposure is away from the premises? Who owns the property being transported? Who's providing the transportation? The key part here, who will suffer the dollar loss if the property is damaged while being transported, while being moved away from the premise or used away from the premise? Own property damage when owner is doing the transportation. Others' property is damaged when someone's providing transportation to someone else's property, or own property damage when others are providing transportation. Those are the three exposure. I am a private carrier hauling my own goods. I'm a for-hire carrier hauling a customer's goods, or I'm a customer having a for-hire carrier hauling my goods. Those are the three exposures. So when is property in transit? Is it on the unit? Is it after, when it's loaded? This is how we negotiated the earlier example I gave you, the beer company. We had the cargo policy attached when the unit was loaded, even though it was still sitting beside the fence. Do we have to have it after it leaves the premises, or do we have wording later you're going to find in a number of the marine forms, again, that we're going to look at that are cargo coverages in the fourth hour when the insurer is responsible for it, or whether it's an insurer's care customer control. So one of the questions you have is, when does policy attach? And it's when the property is in transit. Therefore, the purpose of the marine, again, is for property that is not at a fixed location. So then we look at when property gets damaged, where's the dollars going to come from to replace the property or repair the property? We look at an insurance policy. We look at CPP, commercial package policy. We look at the marine forms that we might write. We look at both. Again, the example I gave you where the cargo policy pays for the 2 cases and the other 8 units that got damaged outside the fence are paid by the CPP policy. Both or neither. That's the one that bothers me. That's why we need to read the coverage forms, but not only the coverage forms because they're not uniform. We need to understand the coverage they had or could have had because there's so much variances in this marketplace. So again, as a insurance provider, we have to rely on, or as a retail agent, we have to analyze the insurance needs, communicate those needs to the insurance underwriter, decide what form fits those needs the best at the price that we can sell, and go from there. There will, in a lot of cases, be areas that we don't cover or could have covered with another carrier at a different price, either, in most cases, more. Again, those things need to be clearly analyzed and explained to the insured. So let's look at the transportation only. Insured, people who have property they own or are responsible for exposed to damage during transportation. There's limited coverage in CP form, and it's only when you have the special cause of loss, and it's limited to $10,000, and it's limited to overturn and theft, but only when you have a locked vehicle. All other marine forms, most of the EDPs, contract equipment, MOP policies, builder's risk policies, things that some of you all are familiar with as a retail agent, and because you also provide coverages for insurers other than transportation entities, know that all those have coverage away from the insured's premises and cover transportation. But we're going to need to address transportation exposure when using an inland marine form that does not include enough limits for transportation, meaning like the CPP policy, the $10,000, or also the enhancement that you have in the commercial package policy. Most insurance carriers have enhancements in the commercial package policies, which comes with the price you pay for the basic coverage. Again, those vary. You need to be familiar with those particular enhancements because they will give extra value. Most of those enhancements are based on inland marine type coverage, accounts receivable, valuable papers, some EDP coverages, and transportation coverage, property covered away from the insured's premise, either being transported or used. So we discussed the forms addressing transportation only is where we want to go here. But again, before you look at those forms, particularly you who write other than truck companies, want to look at what is available in the other forms and then augment or complement what is not covered there with the transportation form that's in marine coverage. So the transportation exposure, when property is being transported, the property can be damaged. The cargo exposure is the dollars lost because of this damage. Consideration again, property coverage for insurance property for most parts are located Pacific, addressing covered property when within many feet describe the premises, usually within 100 feet of the premise standard ISO, some enhancements. Insured then needs to cover the exposure for damage to property while in transit, being moved, if no coverage anywhere else. We have special consideration. These are the three exposures: transporting own property, transporting property of others, having own property transported by others. So transporting own property, those are typically not trucking companies. They're manufacturers, the beer distributor we talked about, a lumber yard, a contractor with their own equipment, a manufacturer of goods, a retail store or a warehouse or a wholesaler that serves retail stores. Transportation is needed because they need to get their property from their warehouse, from their manufacturing, from their yard to the location to use it, but that's not their business. Their business are contractors. Their business is a manufacturer. Their business is a distributor. Their business is a warehouser. Transportation is an important part of their business, but that's not their primary business. We typically call those a private carrier. Transportation property of others is the main focus of the foundation that we have and main focus of most of your people. They provide property of others. Again, they're a bailee. Some of the private carriers, though, don't provide their own property. They hire a motor carrier to haul the property from them, or a railroad or airline. So they're still on the property, so they're still exposed to loss if the property gets damaged while somebody else is providing the transportation. So we have two forms of inland marine that addresses the transportation exposure. There are two transit forms. The first one is the motor carriers. We sometimes have to call the carriers form we have. They are insured are the people who are providing transportation. It can either be a private carrier or it could be a for-hire carrier. But the insured there is the people who own the vehicles, mainly usually trucks, providing the transportation. We also have another form. Some of you might not be familiar with it. It's a very important form in a lot of ways. Later we'll tell you where it's found in other coverage forms, but we have the transit form. This is the insured is the owner of the property and someone else is providing that transportation. Typically, again, this would be a private carrier. One of the reasons that you might not be familiar with it in the book of business that you all deal with is because you write for hire carriers, but it can work in some instances. In a minute we'll talk about how to balance those things. But anyway, the transit form covers the owner of the property no matter who's transporting. The motor carriers form covers the people who are providing the transportation. Let's look at the transit form. It covers, again, the same property the motor carriers form covers. It's the property being transported. However, there's a different interest. The motor carriers cargo form is a person responsible for the loss. They're the people who have the vehicle driving the vehicle, take care of the vehicle from loss, can cause the loss themselves. So therefore, if it's direct coverage, I'm a private carrier, then I have the dollars replaced because it got damaged while I was transporting it. If I'm a for-hire carrier, in a minute we'll talk about my legal liability as a bailee and buying back that. However, the transit form covers the owner of the property being transported by someone else. Because really, who's going to suffer the loss? It's the owner of the property. One of the questions you have is in ownership. When does that ownership transfer? Because you have two parties, the owner of the property, who is the shipper, and the consignee who's getting it. And you have all heard FOB, which means free on board. That typically wording relates to when the property is being moved, the ownership transfers from the shipper to the consignee to the person who's receiving it. This is spelled out in the contract, not with the motor carrier, but the contract with the shipper and the consignee. That's important to determine that, because who's going to suffer the loss and who needs to buy the coverage is a person who would be responsible, who would suffer the dollar loss if it got damaged in transit. So the insurer is the person who suffers a dollar loss if property is damaged. The shipper or receiver of the property, the person at risk because they own it while it's being transported by someone else. So the coverage form type, we have two types. Trip transit, which covers only one trip. Early on in my career, we had a situation where one of the local doctors were buying an x-ray machine. Again, I'm living in Fort Myers, Florida. This x-ray machine was coming out of Seattle, Washington. If you look at the maps, you can't get much further apart and stay in the U.S. than Fort Myers, Florida and Seattle, Washington. This x-ray machine was worth a couple $100,000. Again, this was a long time ago. Today it'd be $1.5 million. And the insured said, I'm not comfortable with the motor carrier being responsible for it. I own it. I had to pay for it. I want to make sure that I have coverage. Can I write a policy? And yes, we wrote them a transit policy. Transit policy covered the x-ray machine owned by this doctor associates, moving from Seattle, Washington to Fort Myers, Florida, and it was lined out being transported by a motor carrier that we vetted to make sure that they were a good motor carrier. They had proper coverage, because if something happened during transportation, we would look to the motor carrier to pay first, and our transit policy would cover an excess of or would subrogate back against the motor carrier if we had to pay a claim. The good part about it is the premium was about $3,500. I got 10%. It was worth my while. The other part is it doesn't do much with renewals because it's over. The most interesting transit policy that I ever got from, there was a gentleman named James Ruke. For you who are listening to this or CIC, know that the seminars are named after Mr. Ruke. He was one of the founders of CIC. He's from San Antonio, Texas. I, fortunately, in my earlier insurance career, had him as a person who mentored me and helped me get started, and we were on a couple boards of CIC, a couple committees of CIC together. He told me about a transit policy he bought to cover one of his exposures in San Antonio, Texas. They were moving a historical building 18 inches. So he wrote a transit form covering the movement of this historical building 18 inches in case it collapsed. So we can write it. Trip Pacific policy addresses that one activity, either x-ray machine from Seattle, Washington to Fort Myers, Florida, or historical building in San Antonio, Texas, moving 18 inches. If it got damaged in those areas, then the policy that we wrote to the owner of the property, the owner of the x-ray machine, the owner of the historical building would pay, and they would then subrogate back against the person who would be responsible for that transportation, either the contractor who was moving the building or the transportation company moving the x-ray machine. We can buy a blanket transit policy. This covers all the exposure, again, to not rely on the motor carrier. My brother-in-law at one point had a marine supply house, and we wrote a blanket transit policy for him to record all of his shipments, and he paid a fee for that part because he was not sure that the transportation company, whether it's U.S. Mail or a UPS or Federal Express. Those people would have adequate coverage for those things. So he listed all the shipments and paid a fee for those shipments. It was more like a fail-safe, and more like a policy that would address it if he could not recover it because he's covering those items. Again, it can be either the shipper or the receiver. You can look at enhancements policies, CPP. A lot of the transit coverage you get today are found in the CPP enhancements and or BOP policies. One interesting thing that you might not have thought about this is a transit policy that a lot of y'all have dealt with if you deal with moving in storage companies, if you've ever moved or had things shipped to airlines or not. Those items could be damaged in transportation. Clearly, the moving and storage company would be responsible, but a lot of moving and storage companies limit their location liability through something called release bill of lading, which we'll talk about here in a minute. I had a call, again, back to my favorite insured, their beer company, on Christmas Eve that says, Tommy, one of our suppliers bought a condominium in Naples, Florida. It's a high-rise. It was overlooking the Gulf of Mexico, and they were shipping property from Germany over to their new condominium through the port of Miami. They were shipping $260,000 worth of their furniture from Germany to their new condo. They shipped it to the port of Miami, and they hired a motor carrier to move it from the port of Miami to their condo in Naples, Florida. For you who don't understand this is a smaller part of Florida. This is the link between what we call Alligator Alley that some of y'all might be familiar with. It's about a 2.5-hour trip, no more than 3, depending on traffic. This motor carrier picked it up at the port of Miami, and for some reason the driver stopped to eat. Even though the insured paid extra fees to make security, stopped to eat shortly after picking up in the port of Miami. He was in this diner for 45 minutes or an hour, and he came back out, and guess what? There was no furniture anymore in his container that he was moving from Naples. So we lost $260,000 worth of cargo. The insured went to the motor carrier and said, where is it? The motor carrier says, well, all I got is $100,000 worth of coverage. I don't know where it is. They hired investigators here. Greg called me up and said, Tommy, what can we do about it? I said, let's go down and have breakfast. Christmas Eve a number of years ago, we had breakfast overlooking the Gulf of Mexico. And I said, let me look at your homeowners policies. And he had a homeowners policy. If you look at the homeowners policy, it says we cover property anywhere in the world. I called his agent up and said, agent, we have a problem here. What do you mean? I didn't mean to cover the transportation of that property. Well, what do you think when you're buying a condo and it's empty, where the property's coming from? And the last time I checked, even though sometimes you don't want it to be, Miami is still in the world. That homeowner's policy paid that loss. They even paid to the cost that we had to try to find out where was stolen it. They even paid for the fees. They did a good job. But that homeowner's policy became the transit policy covering the moving and storage company. My son just moved from Fort Myers to Orlando, and he hired one of these pod companies and asked me, do I need to buy their insurance? I says, no, son, keep your homeowner's policy in place. It'll cover the property being transported by that pod company if they're not responsible for it, while they still have it. Just make sure you have a homeowner's policy in place. So part of the advice, whether you're moving or you have a situation where a client is involved in this, always advise them to keep their homeowner's policies in place until the move is over. Underwriting consideration transit. Key part of it, while it's transported. It's from warehouse to warehouse. The property covers it while it's in the warehouse. Once it gets to the new location, the owner would cover it under their property form. You got to consider the mode of transportation, whether it's transportation companies, UPS, Federal Express, the U.S. Mail, because what's happening in those cases is that we limit the transit policy is designed to cover when the person who's responsible for providing transportation, who would be the legal entity that would be responsible for the transportation, doesn't pay or doesn't pay at all, then the transit policy will step in and pay, take care of the insured's needs, and then go back against the transportation company to recover some, if not all, of their loss. So the bill of lading is a key here, because a lot of the bill of lading spell out things the motor carrier is supposed to do, spell out one of the things we'll talk about in a minute for release bill of lading, which will allow the motor carrier to release their responsibility for the value. There's not many exclusions in there, and the limit can include profit, meaning the sale price, not the replacement price of the property. Again, depends on how it's negotiated. A lot of this, again, is included in the CPP enhancements or in BOP policies. You have to check first. I've seen limits of $10,000. I've seen limits of $100,000 in these enhancements that cover exactly this part, so you don't cover individual policy. And this is where most private carriers obtain their coverage. When providing transportation of their own property, they buy the motor carrier's cargo form. Both fit the private insured providing their own transportation. Which is best? It depends on the coverage and the cost. So for a private carrier, you can write them a transit policy, or you can write them a motor carrier's form, which we'll talk about in a few minutes, to cover that exposure. You just need to see what fits their needs the most. Separate limits are transferred from beyond the basic coverage NDP. Here's a high value item. The property, the motor carrier does not, the owner does not trust the motor carrier then. Or we have agreement. Had a motor carrier or an agent who called me up and said, Tommy, I've got a motor carrier who specializes in shipping boats, but they got a call to ship this very, very valuable boat. Their cargo policy only has $1 million worth of coverage in it, or 500. There, I think it was 500,000. The boat's worth $1.5 million. I can't get anybody reasonable to do that. I said, why don't you go to the shipper, the owner of the boat, and have your insured say, look, I'll cover the 500,000. You release me for liability for that 500,000, and you cover owner of the boat for the $1.5 million. A lot of cases, the owner of the boat already has coverage, either transit form or CPP or other, because a lot of cases are written on that MOP policy. We talk about other for that. This saves the motor carrier from having to buy a one-time policy to cover that exposure. They could have bought a transit policy, or they could have bought a policy and done that, but the most effective way is for the owner of the boat to retain some of the responsibility for the value on their own coverage, which would be a transit form, and your motor carrier would be responsible for the other. That's how it can work in those particular areas. So the need for the transit form within basic coverage, is there enough coverage? It's a fail-safe in case the for-hire carrier is not responsible or not required or doesn't have enough limits required. It could be shipped and released bill laden, like airlines, moving and storage companies, and homeowners. Those would be a consideration. So when I'm going on an airplane, what the airplane tells me is how much they're going to be responsible for my goods. If I carry more than the airplane tells me they're going to be responsible for, then I need a transit policy, which again would be my homeowner's policy, to cover those differences. The form that most of y'all deal with is the motor carrier's cargo form. This is sometimes called the carrier's form. Carrier meaning the person who's providing the transportation. The insured here is the entity providing the transportation, the owner of the trucks, the arranger of the loads, the owner of the trucks who provide the transportation. They're hauled their own goods, a private carrier who is a business other than transportation. Again, manufacturer, distributor, farmer, grower of the property, where they need to move their goods that they have grown, manufactured, sold from their growing facilities, manufacturing facilities, warehouse facilities to their customers. The second type is providing transportation, is when they provide transportation to others. That's the for-hire truckers. Again, the main focus of the business that most of y'all deal with. The motor carrier's cargo form or the cargo form, again, private carriers need because insured is hauling own goods. Insurance business is not transportation. but what they grow, manufacture, sell, or have equipment they need to be transported. It's protection of their own assets. The insurance agreement on that form would typically say, we insure your property while in transit, meaning once there's no away from your premises, the CPP policy, the basic policy doesn't address it, then we cover it. You'll hear that called the owner's form, again, the owners of the property. You don't get many opportunities to write those. I'm sure a few of you write a few of those, but typically your private carrier gets it through another form, like the extensions of their property coverage or the transit forms we discussed earlier. But if you write an individual form from them, it would be the owner's form covering that owned property. The one we deal with most often, again, the core of our business is the for-hire motor carrier. They provide transportation property of others. It is their business providing transportation. They get paid for moving things from point A to point B. If property is damaged while being transported, they will be held responsible to protect the owner of the property, the other's property being transported. That's the bailee responsibility. That's when they're legally liable because they didn't take prudent care of the property in their care, custody, control they're responsible for. This is a property form, but it's triggered by legal liability. That's a court in this particular location, a particular area. Because what happens is I am legally liable for that property, but I have no coverage for that property in my legal liability forms. The general liability policy and the cargo forms has something called a care, custody, or control exclusion that says we don't pay for property in the insured's care, custody, control. So the very basic element of the motor carrier's cargo form, the carrier's form, is to buy back the care, custody, exclusion in their auto form. The for-hire consideration hauls property of others for a fee. That's the bailee responsibility. The insurance agreement in that form will typically say, we insure your property, your liability. That's the key. When you're liable as a motor carrier to loss of property of others, not your property, but property of others. That's the bailee. That you, in transit per tariff schedule of rates, you're getting paid for it upon a bill of lading or shipping receipt. That's the document of carriage. Typically, those are four components that we've made up of the motor carrier's exposure under a cargo form. They're legally liable for property of others, they're getting paid to transport, and there's a document of transportation. There's a document of shipment. That's the bill of lading, the shipping receipt. Those are the four key elements. That's called the legal liability form. The bill of lading is the contract of carriage. This is a very important document in this area. It shows where the property was seized and from whom. The shipper, one who sent the goods, not always the seller. It shows the date of shipment. It shows when the motor carrier becomes responsible, meaning when it loaded, when it's drop and hook, when you have it. It describes the goods by numbers, packages, weights, or other elements. You have something called drop and hook, where the insurer does not see what's in there, the compartments they pick up is already sealed, or you have the shipment, which is count and load. Those are done by the driver, and then later those units are sealed. So those are the two ways. Sometimes the driver has responsibility to oversee the loading and make sure that they count everything there when it's being loaded, and once they do that, they then seal the trailer and then they go forward. Or a lot of times the shipper doesn't allow the driver to count and load. They don't allow the driver to be on the facilities. The driver's either off the facilities or some lounge somewhere, and they're just notified when their trailer is now ready to go. Again, the drop and hook, they don't get a chance to count and to seal. It also spells out the care of the cargo, what temperature it's going to be held at, if it's breakable or not, certain kind of tie-down securities, and those kind of things. It tells the name of the consignee and their address, where it's going to go, and it'll spell out the freight charges. When a loss happens, this is where the adjuster goes to determine what responsibility the motor carrier has for being legally liable for the transportation. And a lot of their liability stems from the agreement in the contract of carriage, which we call the bill of lading. There are two basic types of bill of ladings. Those are the uniform bill of lading, which makes the insured 100% responsible for the value of the property. Or there could be a release bill of lading. This is where the insured is released a value beyond a certain predetermined amount, ones that we've already discussed in the moving and storage industry and the airline. This is the typical uniform bill of lading, making the insured responsible. You got the name of the carrier, commodities being hauled, how they can be delivered, and these things. Later we also will talk about a part of this called the Carmack Amendment, which will be our opening discussions for item 3 that will also be spelled out on this bill of lading. But we could have a release bill of lading. One of the examples I use here, and I've already used it briefly, is anybody who goes on the airline will have the airline, if you read the fine print, used to be on tickets. Now you can go online and read it, or it's in front of the check-in counter you have that says basically, passenger, we're going to take you and $3,500 or $3,400 worth of your luggage and anything else you bring on there, and if that luggage gets lost or damaged, all we're going to pay is $3,400. I don't care what you have in it. That's all we're responsible for. Then any excess they have, they'll offer you excess, but remind you any excess your insured needs would be covered under their homeowner's policy. I once had a local moving and storage company who had the most pervasive release bill of lading that I've seen. This is a part of their building. It's for intrastate only. This could not be done in interstate because of the Federal Moving and Storage Act. But their release bill of lading says, if the shipper does not declare a full value of the items and pay additional valuation, they sell insurance. Liabilities should be limited to 30 cents per pound per article or contents, with a total liability not exceeding $15 per article and $500 for the total shipment. Then the shipper can declare the bill of lading. The motor carrier, the moving and storage company, wanted to limit their exposure. They explained this, and they were schooled by me to tell their shippers, look, before you pay us money, go check with your homeowner's policy. See if the homeowner's policy will cover it in transit. If it does, then you don't need to pay me any more money. But if you need to pay me money, here's the fees. We had this contested in court a couple times, and I will tell you that we always won because it was clearly explained. It was in bold print, and then the shipper, the owner of the property, had the option to either pay more or accept this limitation. The release bill of lading, why used? Where value of items being transferred, hard to determine the value. Again, mainly involving moving storage, where it's limited to $1.25 a pound. The airline, the business, which you don't know what customers are bringing on board, or a lot of times in the intermodal areas where you don't know what the value of what's in the container. Those are the people who are involved in this. They cannot determine the value, so they must limit my exposure or charge you more, meaning my fee I'm charging you to provide this transportation only covers me or only has contemplated X dollars of responsibility, because I don't know what it is. A couch can weigh the same weight but be worth a whole lot of difference in money. Same thing with clothes and other things. Since I cannot determine that, then you're going to release me for that. How the owner of the property is protected, again, extensions of their CPP, right, a transit policy, or their homeowner's policy. Those are, again, how those forms will work together. Underwriting consideration, losses happen. The most frequent loss is collision, overturn. This is the major cause of losses. The second one is theft. The third one is error of the driver or bad equipment. This is when the loads aren't properly secured, particularly if it's a flatbed operation where you have temperature sensitive items and the items are not kept in proper temperature, and you have the spoilage consideration, or the items can be breakage because you don't have the proper packaging and or stacking of the units of the items within the vehicles. So the motor carrier's ability to haul the cargo, this is different in type. A dry van takes very little consideration other than making sure the loads are properly secured with low jacks or other things to keep them from falling over. Whereas someone hauling a reefer, by the way, reefers aren't bad even in places other than Washington and Colorado. Those are temperature sensitive items. Those are reefers as a transportation unit, because now the driver has to make sure that the temperature is properly during the whole transportation exposure, so they have different items. So you have the breakage and spoilage part of it, again, example for the reefer operator. So we underwrite these property coverage, and most of you all who deal in this as an insurance provider, underwriter, have listed cargo, and you have listed cargo that are typed, and usually you have 4 to 6 types, and any type of the cargo falls under that same type. For example, farm equipment would fall in the same type of property as construction equipment, those items. So it's not individual. You look at things theft-prone, breakage, perishable, or size. Those are the 4 things. Is the items we're dealing subject to theft? Is it very breakable? Is it perishable? Does it, if it's not delivered on time, can it be rejected because it wasn't delivered on time, because the temperature has changed? And size, over width, over length, heavy things to haul. Those are the 4 items. And when we're, as a retail agent, set up, our responsibility is to look at those areas of the cargo and break down what the insured is hauling within those items. So how do we look as a retail agent to determine what our insured's hauling? Do insureds remember to tell us about everything they're hauling? We look at SAFER. What you'll find in SAFER is a place there on what commodities insured's hauling. I will suggest you here that that's not always accurate. I suggest you here that we all have seen a motor carrier with 3 or 4 trucks and has checked 8 or 9 boxes. It never fails. I got 4 trucks, but I haul building material, and I haul spoilage, goods, and I haul liquids on one type of a trailer. I mean, that's impossible in those areas a lot of times. So one of the things we want to do, not only to make sure the SAFER is correct, but we want to go to the insured and look at what they say they're hauling in SAFER and say, all right, do you really haul this? How much of each of these do you haul? What you got to remember, and what you got to remind your insured, if it's in SAFER, it doesn't mean that's all they can haul. That's just what the government wants you to be the majority of things. We have reports for CAB or for the carrier software leads. They show customers. Since Analysis Bureau report that most of you as an insurance provider deal with, the carrier's leads, or if we have a program for proprietary to our foundation that will show that, they'll show what their customers are. Where they get that information is that when a DOT officer stops your motor carrier, they make a note who the shipper is on that inspection. And these 2 companies have access to the FMCSA database and captures who the customer is that the DOT officer put down, that gives a indication who they or what they're hauling. So that's the 2 places that we have verification, what the insured told the government they're hauling under SAFER, or what the government found they're hauling at inspection time, roadside inspections time. We can ask the motor carrier who their customers are. You know, have there been any changes in what you've been hauling in the past versus that you're hauling now? What are the loss information? We have to balance all those things. And then we look at the percentage of loads. The type of trailers tell us a lot. Flatbeds, dry vans, reefers, or tankers. There's only certain things to be hauled in those kind of items. But we need to figure out, because we got to make sure we properly cover them, and I don't want any of y'all to cover a beer company with a form that excludes alcoholic beverages. So we need to determine what the insured is covered. And a part of this is go to the insured as a retail agent and say, insured, would you believe that there could be some gaps in coverage? Let's just make sure that we've got you covered properly. So let me know who your customers are and what you're hauling and percentage of each, so we can set it up right. Then underwriters, you take that information and you do your Ouija board, determine how much you're going to price it. The key part of here is driver, because they have the care of the cargo. They have to set the temperature. They secure the machinery. They can put the tarp on it. They secure the loads. You also have the crash prevention on the equipment, rollover stabilizer, lane deviation, crash avoidance equipment, predictor of crash based on the behavior. That's the CSA. CSA is a part of this. It can be used to protect crashes. It can show where you have maintenance. It shows load security in the maintenance compartment, which is important for flatbeds if they're violent. It shows unsafe driving, and a lot of those lead to crashes, falling too close, lane change, speeding. It also shows hours of service violations, which has a concern in a minute because now they're pushing the envelope, but also when they stop is an important part. So we look at the drivers, we look at the MVRs, we look at the previous employers to find out how long we're there. If they jumped around jobs then a lot, then there might be a stability problem, there might be a theft problem. We look at the MVRs, which shows crashes. We look at the pre-employment screening. This shows their activities, not only who they worked for the last 3 years, but they also show if they've had any violations. Also spits out their pay. The more they pay, the better drivers you have, always there. Then we also look at the equipment. Is it capable of hauling it? Is it in good condition? But then we don't think about the length of haul. You all been in my classes and you know that I consider the 300-mile radius is important. Once you get over 300 miles, then a driver has worked all they can work legally before they have to stop. Once they drive 11 hours or work 14 hours, that's including loading and unloading, then they have to stop for 10 hours. If they have to stop for 10 hours, where they're stopping, how secure is that stop? You've increased the theft exposure. So for every radius over those 300 miles, they have to stop. So how often they're going to have to stop during this transportation. Theft is the second major cause. The type of subject to theft. Right now, folks, anything is subject to theft. Thanks to flea markets, thanks to online bids that you can have, because you can steal it if it doesn't have a serial number, if it has a value that people know or have in mind that can be sold, there's no title to it, it can be stolen. There are rings to be stolen on this thing. It's easy to get paid for the items that are stolen for these items. One of the cases I had for an insurance company we do work for out of New Jersey, they had a situation where they had a load of golf balls stolen that they found that was advertised and sold on eBay before they got stolen. That's the kind of stuff today. So theft is rampant, particularly in certain locations, and theft is a problem today because it is easier to get rid of items with the eBay, the public auctions on the computer, flea markets, and non-franchised convenience stores. Theft protection, second cause. What kind of electronic equipment they have in the trucks tracking? Is there signage on the trucks which says this is Tommy Rook's Trucking Company with name and phone number? So if they get stolen, we can call the DOT officer. Instead of saying it's a white Great Dane trailer, it's a trailer with those names. Don't detach it from the power unit. It's easy to steal if it's sitting there. That should be a requirement. I'm not saying limitation in coverage. We'll talk about later, but it should be a requirement. What's the driver break background check? Are they doing it? Are they doing criminal checks, or at least checking previous employments and putting consideration if they moved around? Unfortunately, so much of theft is a derivative of the driver either participating or ignoring. Remember that driver hauling those goods from Germany, taking that rest outside of the port of Miami when they didn't really need to. They could got to Naples, Florida. Did they get paid to do that? Who knows? Driver phone in, not while they're driving, but tracking with the GPS. Then you have to tie recovery. Some of you have listened to our webinars about CargoNet and other services that help cover. Main importance to focus on these items for the drivers for the insured to understand what they can do to prevent theft. So recap, part 2. What is in a marine? We talk about forms are different. You must read, understand, and meet the insured's needs with the form provided. We have the two types of forms. A transit form we discussed in some depth, who is protecting the owner of the property being transported, and the motor carrier's form, which covers the entity providing the transportation. Bill of lading is important, particularly the release bill of lading, how it can be properly used. Underwriting is based on the type of the cargo and the drivers and the motor carrier's past history and ability to handle the cargo. This is, again, the end of the second hour of a 4-hour program. We look forward to your participation in all 4 hours. If you have any questions, email us at trs@ibci.net or call us at 800-741-4084. With that said, we'll see you next time.